Most people who invest in ETFs think they are doing everything right. They picked a low-cost fund, they set up automatic contributions, and they told themselves they were playing the long game. But quietly, slowly, and sometimes catastrophically, a handful of very common mistakes are draining thousands of dollars from their portfolios. And the worst part is that most investors never even realize it is happening. Today, I want to walk you through 7 of those mistakes. Not in theory, but with real numbers and real examples, so you can see exactly what the damage looks like and what you can do about it starting today. Let's start with mistake number 1, and it is probably the one nobody warns you about: chasing performance. Here is how it plays out. An investor sees that a technology ETF returned 40% last year. They do some research, they feel excited, and they pour a significant portion of their savings into it. What they do not realize is that by the time a fund shows up on a best performers list, the easy money has usually already been made. A perfect example of this happened with ARKK Innovation ETF, ticker ARKK. In 2020, it returned over 150%. Billions of dollars flooded into it in early 2021 from investors who saw the headline numbers. Over the next 2 years, the fund lost roughly 75% of its value from its peak. Many of those late investors locked in enormous losses precisely because they let past returns make the decision for them. Past performance is not just a disclaimer, like it is a warning. Mistake number 2 is paying too much in fees without realizing how devastating that actually is over time. Let me give you the math on this because the numbers are genuinely shocking. Say you invest $100,000. One option charges you an expense ratio of 1% per year. Another charges you just 0.03%, which is roughly what you pay with something like Vanguard's Total Stock Market ETF, VTI. If both funds return the same 7% annually before fees, after 30 years the low-fee investor has approximately $760,000. The high-fee investor has just over $570,000. That is a difference of nearly $200,000. Money that did not go to your retirement. It went to the fund company. 1% sounds like nothing. Over a lifetime, it is a house. Now let us talk about mistake number 3, which is over-diversifying into funds that are secretly doing the same thing. A lot of investors hold 3, 4, sometimes 5 ETFs and feel like they are well diversified. But if you hold the S&P 500 ETF, a large cap growth ETF, a technology sector ETF, and a NASDAQ 100 ETF all at once, you are not diversified. You are just holding Apple, Microsoft, and Nvidia 4 times over. This is called overlap, and it is more common than most people think. The practical problem is that when one of those holdings drops hard, every single fund in your portfolio drops right along with it, because they are all exposed to the same companies. True diversification means spreading across things that do not move in lockstep, like adding international exposure, small cap funds, or bonds, not just collecting different names that hold the same underlying assets. Mistake number 4 is ignoring taxes, and this one quietly costs some investors more than any fee ever could. A lot of people treat their ETFs the same regardless of which account they are sitting in. But where you hold an ETF matters enormously. If you are holding a high dividend ETF in a taxable brokerage account, you are paying ordinary income tax on those distributions every single year, even if you reinvest all of them. Move that same ETF into a Roth IRA or a traditional IRA, and the tax drag disappears. Meanwhile, a fund like a broad market index that generates very little in the way of distributions can sit in a taxable account quite efficiently. This is called asset location, and it is one of the most underused tools in a retail investor's arsenal. The right fund in the wrong account can cost you tens of thousands of dollars over a decade. The fix is free, yeah, it just requires paying attention. Mistake number 5 is panic selling during downturns. And I know you have heard this before, but I want to show you what it actually costs, rather than just telling you to stay calm. During the COVID crash in February and March of 2020, the S&P 500 dropped roughly 34% in about 5 weeks. It was terrifying. A significant number of retail investors sold out of their ETF positions during that period to stop the bleeding. The index then recovered all of its losses in about 5 months and went on to deliver extraordinary returns over the following 2 years. An investor who held $100,000 in a broad market ETF and sold at the bottom, then waited 6 months to feel confident before getting back in, would have missed a recovery worth tens of thousands of dollars. And the bitter irony is that this pattern, selling low and buying back in high, is one of the primary reasons the average investor dramatically underperforms the funds they are actually invested in. Mistake number 6 is investing in leveraged or inverse ETFs without fully understanding what they are designed to do. These are products like a 3 times leveraged S&P 500 fund or an inverse fund that goes up when the market goes down. And they are aggressively marketed as ways to amplify returns or protect against downturns. What the marketing materials do not emphasize clearly enough is something called volatility decay. These funds are designed to deliver their stated multiple on a daily basis, not over months or years. Over time, the daily rebalancing required to maintain that leverage mathematically erodes the value of the fund, even if the underlying index ends up flat. To illustrate, if an index goes up 10% one day and down 10% the next day, you are roughly back to where you started. But a 2 times leveraged fund that goes up 20% and then down 20% leaves you at 96 cents on the dollar, not $1. Repeat that process over hundreds of trading days and the erosion becomes severe. These are sophisticated instruments built for short-term traders. When long-term investors hold them for months thinking they are juicing their returns, the results are often genuinely painful. And then there is mistake number 7, which is the one that ties everything together: not having a plan and just reacting. The investors who do the worst in ETF investing are not always the ones who made the biggest single mistake. They are the ones who are constantly adjusting their strategy based on the news, switching funds based on what performed well recently, adding new positions on impulse and never cleaning up the old ones, and generally making dozens of small reactive decisions that compound into a messy, incoherent portfolio with high turnover and no clear direction. A simple written investment plan, even 2 paragraphs long, that says what you are investing in, why, how often you are contributing, and under what specific circumstances you would make a change, acts as an enormous behavioral anchor. It does not have to be complicated. The investor who holds 3 to 4 well-chosen ETFs for 20 years with consistent contributions will almost certainly outperform the investor who holds 15 ETFs and makes changes every time something interesting happens in the market. So let me bring this together quickly. Do not chase last year's winners. Pay obsessive attention to expense ratios because the math over decades is brutal. Check your holdings for overlap before you call yourself diversified. Think carefully about which accounts your ETFs are sitting in. Have a plan for what you will do during a downturn and write it down before the downturn happens. Stay far away from leveraged and inverse ETFs unless you genuinely understand how they work and you have a very specific short-term strategy. And above all, build a simple, consistent plan and protect it from your own impulses. The market will reward patience. It always has. The only question is whether you will still be holding on when it does.